When you step into the market, you rarely realize that the real battlefield isn't the chart, the trend, or the economic report. It's the space between your ears. Every trader comes armed with tools, indicators, strategies, and predictions, but very few walk in with the one element that determines everything: the right mindset. Markets don't reward intelligence, talent, or even experience. They reward psychological consistency, the internal ability to think in probabilities, detach from fear, and act without hesitation. Most traders spend years searching for the perfect system, but almost none spend the same energy learning how to manage their emotional responses. Fear, greed, hope, regret. These aren't just feelings, they're forces capable of shaping behavior so dramatically that even a proven strategy becomes useless. The true challenge of trading isn't learning how the market moves. It's learning how to move when the market challenges your beliefs, your patience, and your discipline. The market offers endless opportunities, but only to the trader who can respond to uncertainty without collapsing into chaos. That requires internal structure, a mental framework that allows you to operate in an environment where nothing is guaranteed, everything is possible, and outcomes unfold independently of your last trade. When you accept that every moment in the market is unique, you start trading what is, instead of defending what you want it to be. But this kind of mental clarity doesn't happen automatically. It must be trained. It must be cultivated through deliberate awareness, self-honesty, and a deep willingness to see where your beliefs dilute your progress. The market exposes every weakness: impatience, stubbornness, the need to be right, the fear of losing, the obsession with certainty. Each reaction becomes a lesson, not because the market teaches, but because it reflects your internal world back to you with perfect neutrality. These 25 lessons are not techniques or motivational slogans. They are psychological principles designed to reshape the way you perceive risk, uncertainty, and opportunity. They challenge the illusions that cause traders to sabotage themselves. The belief that you can predict outcomes, the belief that your analysis guarantees results, the belief that one trade defines your identity. When these illusions dissolve, trading becomes simpler, clearer, and far less emotional. Every consistent trader eventually realizes that the market doesn't create pressure, the trader does. The charts don't create fear, the meaning you attach to the trade does. Losses don't cause emotional damage, your interpretation of them does. The moment you accept that your experience in the market is self-generated, you regain control of your behavior. And with that control comes freedom. The freedom to execute objectively, the freedom to wait patiently, the freedom to trade without emotional compensation. This introduction opens the door to understanding the internal architecture required for long-term success. These lessons guide you toward a mindset where probability replaces prediction, presence replaces expectation, and discipline replaces emotional impulse. They reveal the psychological foundation that allows a trader to remain stable amid volatility, confident amid uncertainty, and consistent amid chaos. Trading in probabilities rather than predictions requires a fundamental shift in how you perceive the market, yourself, and the nature of outcomes. Most traders approach the market looking for certainty, wanting confirmation that a trade will work, or trying to find the perfect signal that guarantees profit. This mindset is rooted in the human desire to avoid loss, avoid being wrong, and avoid emotional discomfort. But the market is an environment where anything can happen at any moment, where every outcome is independent, and where no amount of analysis can guarantee precision. To think in probabilities is to accept the reality that the market does not owe you consistency. You must create it through your mindset. When you trade with predictions, you're mentally locking on to a specific outcome as if the market is required to fulfill your expectations. You become attached to being right, and that attachment blinds you to everything the chart is actually communicating. If the market moves against you, you feel attacked. If the market hesitates, you feel anxious. Every candle becomes a threat because you're emotionally invested in a single future scenario you've simulated in your mind. This rigid mindset leads to hesitation, early exits, revenge trades, and a constant emotional roller coaster. Thinking in probabilities frees you from this internal trap. When you operate with a probabilistic mindset, you understand that any trade can win or lose, no matter how perfect the setup appears. You recognize that the edge you rely on is not about certainty, it's about consistency over a series of trades. A trader who thinks in probabilities doesn't judge themselves by the outcome of a single position. Instead, they evaluate whether they executed their plan, managed risk correctly, and stayed emotionally neutral. This approach allows you to remain steady even when the market behaves unpredictably, because unpredictability isn't a threat. It's a natural part of the trading environment. Embracing probabilities means accepting that losses are not failures. They are simply part of the distribution of outcomes. Every edge has a mix of wins and losses, and no individual outcome carries meaning beyond being one data point in a larger sequence. Traders who truly absorb this concept stop taking losses personally. They don't see them as attacks on their competence or intelligence. They see them as necessary components of the process. This shift removes emotional resistance to cutting losses, following stops, and staying patient. Trading becomes less stressful because you no longer need the market to do anything for you. You're free to observe instead of hope, respond instead of react. You become more objective because your expectations no longer distort your perception. Thinking in probabilities strengthens your ability to execute consistently. When you know that any individual outcome doesn't matter, you stop hesitating. You stop questioning yourself mid-trade. You stop holding trades longer than your plan because you hope they'll come back. You stop skipping trades out of fear that this one might lose. Probabilistic thinking breaks the emotional cycle that keeps traders stuck between fear and greed, hesitation and impulsiveness, confidence and doubt. A trader who thinks in probabilities understands that their role is not to predict, but to manage uncertainty. You place trades because your edge tells you there is a favorable chance over time, not because you believe you know what will happen next. You size positions based on risk rather than expectation. You accept the randomness within the short term and trust the consistency that emerges over many repetitions. This mindset also reshapes the way you interpret market information. Instead of trying to read every candle as a decisive signal, you start to understand that the market expresses itself in patterns of probability. A setup that appears strong does not promise a win. It simply indicates that the odds tilt in your favor. A stop loss being hit doesn't mean the market was against you. It means this outcome was one of the natural variations in the distribution. When you detach from certainty, you no longer seek the perfect trade. You seek the valid trade. You seek alignment between your edge, the current conditions, and your rules. This prevents overanalysis, system hopping, and emotional decision-making. Probabilistic thinking promotes emotional neutrality. When outcomes lose their psychological meaning, you regain the ability to think clearly. You stop reacting to the emotional weight you assign to outcomes. Your mind becomes calm because there is no longer a fight between what you want the market to do and what it is doing. Fear diminishes because uncertainty stops feeling dangerous. Greed fades because you no longer chase the illusion of a guaranteed outcome. Regret disappears because you recognize that every outcome could have gone either way. You start viewing your trading performance the same way a casino views its gaming tables. Casinos don't panic over a single winning gambler because they understand the long-term expectancy favors them. In trading, your edge is your expectancy, and the only way to benefit from it is to let the law of large numbers unfold. This means taking every valid setup without exception, without hesitation, without emotional interference. Thinking in probabilities requires absolute acceptance. Acceptance that you do not know what will happen next. Acceptance that you don't need to know. Acceptance that the market is not predictable, but is exploitable through patterns. And acceptance that your job is not to control outcomes, but to control your behavior. When you internalize this concept, your emotional responses shift dramatically. You stop fighting the market. You stop defending your analysis. You stop searching for certainty. You stop attempting to avoid losses. Instead, you embrace uncertainty as the natural environment of the market. You align with it instead of resisting it. Probabilistic thinking becomes the foundation for discipline because discipline makes sense only when you view trading as a game of large numbers. It becomes the foundation for confidence because confidence grows when you stop relying on predictions and start relying on process. It becomes the foundation for consistency because consistency can only emerge when your actions remain stable, regardless of short-term outcomes. This mindset gives you the freedom to let go of the emotional burdens that hold traders back and creates the internal structure necessary for long-term durability in the markets. Detaching your identity from individual outcomes is one of the most transformative psychological shifts a trader can make. Yet, it's often the most difficult because it demands confronting how deeply the need to be right is wired into your thinking. From childhood, people are conditioned to equate being right with competence and being wrong with failure. In trading, this conditioning becomes a trap. The market creates an environment where being wrong is inevitable, where losses occur even when you follow your plan perfectly, and where outcomes often contradict your expectations. If your sense of self-worth becomes tied to each result, you will experience emotional swings so strong that they override logic, discipline, and objectivity. The key is understanding that the market does not judge you, reward you, or punish you. It simply reflects probabilities, and your job is not to validate your identity, but to execute your edge regardless of outcomes. To detach your identity from results is to separate who you are from what any single trade does. When a trader attaches their sense of value to being right, every losing trade becomes a personal attack. A stop loss being hit feels like a failure rather than a routine part of the distribution. A winning trade inflates the ego and encourages overconfidence, leading to risk-taking that has nothing to do with the strategy. This creates a dangerous psychological cycle. The trader becomes addicted to the emotional high of winning and terrified of the emotional pain of losing. Instead of responding to the market, they react to the emotional meaning they assign to each outcome. They avoid taking valid trades out of fear of being wrong. They hold losing trades because accepting the loss would damage their identity. They cut winners too early because they are afraid to lose the feeling of temporary validation. This emotional attachment transforms trading from a process into a personal battle with the market, where the focus is no longer on performance, but on protecting the ego. When you detach your identity from outcomes, the market stops being a mirror reflecting your personal worth. Each trade becomes just a trade, nothing more. A win isn't proof of your intelligence. A loss isn't evidence of incompetence. Outcomes stop carrying emotional weight, and without that emotional load, your decision-making becomes clearer, calmer, and more consistent. The entire experience of trading changes when you no longer interpret results as reflections of your value. You're able to accept losses immediately. You're able to execute without hesitation. You're able to stay focused on the long-term progression of your edge instead of obsessing over the short-term fluctuations. Detachment allows you to become neutral, and neutrality is where objective trading begins. Detaching your identity requires shifting your internal dialogue. Instead of thinking, I was right or I was wrong, you begin thinking the market produced a statistically normal outcome. Instead of turning outcomes into narratives about yourself, you see them as data points. This is one of the most essential components of a trader's mental evolution, realizing that the need to be right is incompatible with the nature of trading. Markets operate in uncertainty. They deliver mixed results. They contain elements of randomness that no one can control. If your identity depends on certainty, you will always feel threatened, always feel pressured, and always feel reactive. When identity becomes detached, uncertainty no longer feels dangerous because it no longer threatens your self-worth. Traders who internalize this concept stop judging themselves trade by trade. They focus on the quality of execution rather than whether the trade won or lost. They evaluate whether they followed their rules, not whether the result matched their expectations. This shift is critical because it aligns your mindset with the structure of probability-based success. If your identity is attached to outcomes, you will never follow your plan consistently. Consistent execution requires emotional neutrality, and emotional neutrality is impossible when every outcome feels personal. Detachment is not avoidance, suppression, or indifference. It is clarity. It is the ability to act without emotional distortion. It is the space between your actions and your psychological reactions. It allows the edge to manifest over time because you're no longer sabotaging the process with impulsive behavior driven by fear or pride. When your identity is tied to being right, trading becomes a test of validation. You take oversized trades to prove your analysis is superior. You hold losers because accepting a small loss feels shameful. You double down because admitting defeat feels too painful. Every action becomes emotionally charged, and emotional trading inevitably leads to inconsistent performance. When you detach your identity, trading becomes an execution process. You operate based on rules, probabilities, and predefined structures. You no longer need the market to agree with you. You no longer seek confirmation from outcomes. You no longer measure success by the result of one trade, but by your ability to execute a series of trades with discipline. Detaching your identity also frees you from the illusions of control. When traders personalize outcomes, they often unconsciously believe they can influence the market through analysis, effort, or intensity. This illusion leads to frustration because the market behaves independently of your internal state. When outcomes aren't personal, you stop trying to control what you cannot control and begin managing what you can, your actions, your risk, your discipline, and your emotional state. You stop feeling betrayed by the market because betrayal is a personal interpretation. You stop feeling punished by losses because punishment requires intention, and the market has none. You stop feeling overly proud of wins because pride becomes unnecessary when your identity is not tied to temporary outcomes. This mindset creates emotional resilience. You no longer collapse after a losing streak because those losses don't define you. You no longer become reckless after a winning streak because those wins don't elevate you. You maintain stability regardless of short-term results, which is the foundation of long-term trading consistency. Detachment is not coldness, it is freedom from emotional bias. It is what allows you to see the market clearly instead of through the filter of your psychological needs. It allows you to trade without fear because nothing about the outcome threatens who you are. It allows you to take losses with ease because the loss does not affect your self-image. It allows you to stay committed to your edge because you no longer abandon it to protect your ego. Detaching your identity from individual outcomes transforms trading from an emotional struggle into a structured process. It moves you away from self-validation and toward objective execution. It shifts your focus from needing to be right to needing to be consistent. It dissolves the emotional distortions that lead to impulsive decisions, hesitation, revenge trading, and overconfidence. Each outcome becomes nothing more than data, and data has no power to define or damage you. This psychological shift forms the foundation for developing a professional mindset and becoming a trader capable of operating with clarity, discipline, and mental stability in an environment defined by uncertainty and probability. Eliminating emotional attachment to wins and losses means stepping into a psychological space where outcomes no longer have the power to distort your perception, your decisions, or your behavior. In trading, emotional attachment develops because each outcome carries a meaning you've assigned to it. A win feels like validation, competence, control, and success. A loss feels like failure, inadequacy, and defeat. This emotional interpretation becomes the root of nearly every destructive trading habit: overtrading after a win, hesitating after a loss, cutting winners too early, letting losers run, moving stops, revenge trading, and constantly shifting strategies. The market isn't causing these behaviors. The emotional meaning you attach to outcomes is. When you detach your emotions from wins and losses, you create the psychological stability needed to execute consistently, regardless of what any single trade produces. Most traders don't realize how much of their behavior is driven by emotional attachment. A win feels good, and the mind unconsciously chases that feeling by taking impulsive trades or increasing position sizes. The emotional high becomes addictive, not because the money matters, but because the win temporarily fills a psychological need. On the other hand, a loss feels painful, not because of the money itself, but because it threatens your sense of competence or damages your self-image. This pain leads to avoidance, hesitation, and behaviors rooted in trying to escape discomfort rather than following the trading plan. Emotional attachment transforms trading into a cycle of highs and lows, where the trader becomes reactive instead of strategic. Eliminating that attachment allows you to see the market without projecting your emotional state onto it. To eliminate emotional attachment, you must first understand what creates it. The human mind naturally seeks patterns that connect experiences with meaning. When you win a trade, you may unconsciously interpret it as proof that your analysis was correct or that your skills are improving. When you lose, you may interpret it as rejection or failure, even though the outcome might simply be the natural variance within your edge. Trading is a game of probabilities, but emotional attachment makes it feel like a game of self-worth. It turns every trade into a personal evaluation, and once trading becomes personal, objectivity disappears. Removing emotional attachment means removing the personal meaning you assign to results. When you no longer attach emotions to wins, you stop feeling invincible after a profitable trade. You stop increasing your size impulsively. You stop believing the market will continue rewarding you because you feel confident. Confidence that comes from a single win is false confidence. It is emotional confidence, not process confidence. Emotional confidence leads to careless mistakes because it distorts your perception of risk. When you detach emotionally, a win simply becomes confirmation that your edge has probabilities in its favor, nothing more. You take the win without celebrating, without exaggerating your skill, and without assuming that the next trade will be similar. This neutrality protects you from one of the most dangerous psychological traps in trading, the belief that success in the short term guarantees success in the long term. When you no longer attach emotions to losses, they lose their power to disrupt your psychological state. A loss becomes a neutral event. It becomes data. It becomes part of the distribution of outcomes rather than a personal setback. This shift is essential for consistency because losses are unavoidable. If every loss triggers frustration, doubt, or fear, you will never maintain discipline across a series of trades. Emotional attachment to losses makes you change your rules mid-trade, hold on to losers too long, or exit winners early out of fear. It makes you hesitate to take valid setups because you're trying to avoid discomfort rather than execute your edge. When you detach, you stop fearing losses because they no longer threaten you emotionally. They become acceptable, manageable, and structurally aligned with how trading actually works. Eliminating emotional attachment also means shifting how you interpret streaks. A winning streak does not make you superior, and a losing streak does not make you inferior. Both are simply clusters of outcomes within the larger sample size. Traders who attach emotions to results tend to fall into psychological extremes. Euphoria during a streak of wins, and despair during a streak of losses. Both states distort perception. Euphoria makes you reckless, despair makes you fearful. Detachment allows you to remain stable in both situations, which is crucial because your edge only reveals itself over many trades. Emotional attachment destroys that consistency by causing the trader to fluctuate between overconfidence and paralysis. Another critical aspect of eliminating emotional attachment is understanding that the market does not care about your desires, expectations, or emotional state. The market doesn't reward effort or intention. It doesn't respond to how badly you want to win or how deeply you fear losing. When traders attach emotions to outcomes, they often fall into the illusion that the market is responding to them personally. This illusion creates frustration because it makes random market behavior feel like resistance or punishment. When you detach emotionally, you stop projecting personal meaning onto impersonal events. You stop expecting the market to react according to your hopes. You stop feeling betrayed when a trade doesn't work. This clarity restores objectivity and eliminates unnecessary emotional suffering. Detaching from emotional reactions also enhances risk management. When you're no longer emotionally attached to outcomes, it becomes easier to follow your stop loss, size your positions appropriately, and avoid impulsive changes in risk. Emotional attachment causes traders to ignore risk rules because they believe the emotional weight of the outcome justifies exceptions. Detachment makes you treat risk as a structural part of the process rather than a threat. You begin to see risk as a tool rather than a danger, which is exactly how professional traders operate. This detachment also improves patience. When you're emotionally attached to winning, you feel pressure to be in the market constantly, chasing trades out of boredom or fear of missing out. When you detach, you no longer need the emotional comfort of being in a trade. You wait for valid setups because your satisfaction doesn't come from the thrill of being involved, but from the discipline of following your process. Patience becomes natural because you're no longer trying to satisfy an emotional craving. Eliminating emotional attachment is ultimately about freedom. Freedom from internal pressure, freedom from fear, freedom from the highs and lows that distort clarity. It allows you to act based on logic rather than emotion, process rather than impulse, probabilities rather than personal meaning. It allows you to see the chart as it is instead of through the lens of desire and fear. It creates the psychological foundation necessary for long-term consistency because you become stable in the face of uncertainty. This stability is what separates traders who survive from those who burn out under the weight of emotional swings. Responding to the market rather than reacting to it requires developing a level of internal balance that allows you to observe price action without letting your emotions dictate your decisions. Most traders believe they are responding to the market, but in reality they are reacting to fear, reacting to hope, reacting to pressure, reacting to the meaning they project onto a candle or a fluctuation. A reaction is unconscious, emotional, and impulsive. A response is conscious, deliberate, and grounded in clarity. The difference between the two determines whether you trade with stability or chaos. When you react, the market controls you. When you respond, you operate from your plan, your rules, and your edge. This distinction forms the psychological line between professional and amateur behavior. Reacting to the market often happens because traders expect the market to behave in a way that confirms their analysis. When the market does something unexpected, an emotional surge occurs. Fear when price moves against you, excitement when it moves in your favor, frustration when a setup doesn't trigger, impatience when the market moves slowly. These emotional states drive impulsive actions, jumping into trades out of fear of missing out, exiting prematurely because of anxiety, doubling down because of anger, abandoning rules because the market isn't behaving the way you want. These reactions have nothing to do with what the chart is actually telling you. They are distortions created by emotional pressure. The market becomes a mirror for your internal psychological patterns, and your trading becomes a projection of your fears and desires rather than a reflection of objective reality. Responding to the market requires cultivating emotional neutrality. Neutrality means that the information the market provides is received without emotional interpretation. A candle moving against your position is simply a candle, not a threat. A breakout is just a price expansion, not a guarantee of profit. A stop loss being hit is nothing more than part of the statistical expectancy. Neutrality allows you to see what the market is doing instead of what you fear or hope it does. When you are neutral, you can wait for your setup to form without rushing. You can sit through noise without panicking. You can follow your rules without feeling pressured to alter them. Responding becomes possible only when your mind isn't overwhelmed by emotional noise. To respond rather than react, you need clarity about your role in the market. Your job is not to predict, control, or force outcomes. Your job is to read the structural behavior of price and align yourself with your predefined edge. If the market doesn't offer an opportunity, you do nothing. If the market hits your stop, you accept it instantly. If your setup appears, you execute without hesitation. Responding means acting according to your plan, not your emotions. It means staying consistent in your actions even when outcomes fluctuate. It means trusting the process rather than fighting the unpredictability of the moment. You no longer trade to satisfy emotional urges, you trade to express your edge. Reacting, on the other hand, comes from internal pressure. This pressure builds when you attach emotional significance to outcomes or when you believe the market must behave a certain way for you to feel safe. When the market doesn't align with your internal expectations, fear and frustration take over. Reacting is always tied to expectation. Responding is tied to observation. When you expect the market to move in your favor, you react when it doesn't. When you observe the market without expectation, you respond to what is actually there. This distinction allows you to remain stable while others get swept away by emotional currents. Trader who reacts is always late. They enter late because they wait for emotional confirmation. They exit late because they hope things will improve. They reverse positions impulsively because frustration builds up. They take trades without planning because impatience overwhelms discipline. A trader who responds acts on structure, not emotion. They enter when the plan signals entry, even if they feel uncertain. They exit when the plan signals exit, even if they feel hopeful. Their behavior stays steady because it isn't controlled by the emotional meaning of the moment. Responding allows consistency. Reacting creates randomness. Responding requires accepting uncertainty. If you need the market to behave in a predictable way, you will always react emotionally when it doesn't. But when you accept that every moment is unique and that anything can happen, you stop trying to force certainty into an environment that doesn't offer it. This acceptance becomes the foundation of calm execution. You stop resisting the market's movement and start flowing with it. You no longer panic when price moves sharply because sharp movement is simply one expression of market behavior. You no longer stress when the market consolidates because consolidation is part of the cycle. Acceptance dissolves resistance, and with resistance gone, emotional triggers lose their power. Learning to respond instead of react also changes how you interpret time. Reacting creates urgency. You feel rushed to enter. You feel pushed to exit. You feel pressured to make something happen. Responding creates patience. You stop needing to be in a trade. You stop needing instant results. You stop chasing the market. You begin waiting for the moment your edge presents itself. When you respond, your sense of timing aligns with your rules, not your emotions. You become patient because you no longer need the trade to satisfy a psychological need. Another critical part of responding is understanding context. Reaction focuses on the most recent price movement without considering the broader structure. Response sees the larger pattern and recognizes that one candle doesn't define the market. A reaction looks at a red candle and panics. A response looks at the trend, the support level, the context, and sees whether the candle is meaningful or just noise. This ability to contextualize information prevents you from making impulsive decisions based on isolated movement. It brings clarity and reduces emotional volatility. Responding also requires building trust in your edge. Trust grows through repetition and discipline. The more consistently you follow your rules, the stronger your internal belief in the process becomes. Reactions come from insecurity. Responses come from confidence in structure. When you trust your edge, you no longer need to second-guess every decision. You no longer need constant reassurance. You no longer distort information to match your fears. Trust creates mental stability, and stability is what allows response to replace reaction. Ultimately, responding to the market means developing a mindset where your actions come from clarity rather than emotion. It means observing without projecting, waiting without fearing, executing without hesitation. It means operating with the understanding that the market is neutral and that your reactions are self-generated. When you stop reacting, you take back psychological control. When you start responding, you trade with intention rather than impulse. Shift forms the foundation of consistent execution because the quality of your decisions becomes independent of your emotional state and fully aligned with the logic of your process. Consistency coming from disciplined execution rather than analysis requires a complete reorientation of how you approach the market and what you believe creates success. Most traders spend years looking for better analysis, sharper indicators, deeper market knowledge, or perfect confirmation signals, thinking that if they understand more, they will finally become consistent. But the truth is that the market does not reward intelligence alone. It rewards the ability to execute your plan the same way every time under varying emotional conditions. Analysis can help identify opportunity, but execution determines whether you benefit from it. Without disciplined action, even the best analysis becomes meaningless. Consistency is a behavioral achievement, not an intellectual one. Many traders fall into the trap of believing they need more certainty before taking a trade. They keep analyzing, adjusting indicators, adding confluence, seeking more reasons to believe they are right. This constant search for confirmation stems from emotional discomfort with uncertainty. The more uncomfortable you are, the more analysis you seek, because analysis feels like control. But the market cannot be controlled, and no amount of analysis can remove uncertainty. The more you analyze, the more you delay execution. The more you seek perfection, the more opportunities you miss. The more you depend on analysis, the more fragile your trading becomes because analysis changes with every candle while discipline remains constant. Disciplined execution means having clarity about your rules and acting on them without hesitation. It means entering when your setup appears, even if you feel uncertain. It means exiting when your stop loss is hit, even if you feel hopeful. It means taking profits when your plan says to take them, even if greed whispers that more is possible. Discipline is the bridge between your edge and the outcome it can produce over time. Without that bridge, your edge never gets to express its statistical power. Most traders actually have edges that could work if executed consistently, but emotional inconsistency prevents those edges from unfolding. They trade differently when winning than when losing. They trade differently when confident than when fearful. Their behavior fluctuates, and so do their results. Analysis might help you understand the market, but discipline helps you survive it. The market is constantly shifting, presenting new conditions, new volatility, new traps. Analysis bends under emotional pressure because you will always interpret whatever you see through your current emotional state. A fearful trader sees danger everywhere. An overconfident trader sees opportunity everywhere. A frustrated trader forces trades. This distortion is why relying on analysis alone leads to inconsistency. Discipline, however, remains stable regardless of emotional fluctuations. It serves as your internal framework, ensuring your actions remain consistent even when the market becomes chaotic. Disciplined execution also means respecting your risk parameters every single time. You size positions according to your rules, not your feelings. You don't increase your lot size after a win out of excitement. You don't double down after a loss out of frustration. You understand that risk management is not optional. It is part of execution. Consistency in risk creates consistency in emotional stability. When your risk is stable, your mind remains clear. When your risk fluctuates emotionally, your psychology becomes volatile, and volatile psychology destroys disciplined execution. Most traders mistakenly believe that discipline comes after confidence, but the opposite is true. Confidence grows from disciplined repetition. When you execute your plan over and over, you begin to trust it. You see patterns emerge. You see the edge reveal itself. You learn that losses are normal, wins are normal, and both are manageable when your actions remain stable. Without discipline, your results become random, and no trader can build confidence on randomness. Consistency in behavior is what creates consistency in outcomes over the long term. Trader who relies on analysis for confidence will always struggle because analysis changes as conditions change. When the market behaves unexpectedly, the analysis-based trader freezes. They hesitate, overthink, or look for additional confirmation. A disciplined trader responds to structure. They understand that they don't need certainty. They just need to act on their edge with neutrality. They accept that the outcome is independent of their effort and that the quality of their decision is measured by adherence to the rules, not by whether the trade wins or loses. Disciplined execution also protects you from emotional extremes. After a loss, analysis-driven traders often start doubting their strategy, tweaking rules, adapting the system, or switching methods entirely. This prevents them from ever allowing an edge to play out. After a win, they become overly confident, take impulsive trades, or break rules because the emotional high overrides rational thinking. Discipline neutralizes these extremes. When you follow your rules regardless of outcome, both wins and losses lose emotional intensity. They become simple data points. You avoid the psychological cycle that destroys consistency. To execute with discipline, you must build habits that override emotional impulses. This means having a written plan, predefined entries, exits, stop-loss levels, and risk parameters. It means practicing the same behavior until it becomes automatic. Discipline is not about forcing yourself to act correctly through willpower. It is about training yourself through repetition until the correct action becomes the only action. Professionals don't need to rely on emotional strength to behave correctly. They rely on structure. Structure eliminates decision-making in the moment, which eliminates hesitation and reactivity. Consistent traders understand that their job is to follow their rules, not to interpret the market emotionally. They don't reopen closed trades, chase price, or deviate from their system because of temporary feelings. They execute with mechanical precision, not because they are unemotional robots, but because they have learned that emotions are unreliable guides in an environment defined by randomness and uncertainty. Their consistency comes from a disciplined trust in their process. When you understand that analysis does not create consistency, your priorities shift. You stop trying to perfect your strategy and start perfecting your behavior. You stop obsessing over the market and start focusing on your execution. You stop trying to predict and start managing probability. You stop chasing certainty and start cultivating discipline. The more consistent your execution becomes, the more predictable your results become over time. Consistency emerges not from knowing more, but from doing the right thing repeatedly. It is built on disciplined action, stable risk, emotional neutrality, and unwavering commitment to process. This is what separates traders who drift from one method to another from those who develop a lasting, repeatable, professional approach to the market.